Welcome back to Smart Stock Sam. Today, we're diving deep into SoFi Technologies to answer the ultimate question. Is this your last chance to buy before a massive upside breakout, or are we staring at a value trap disguised as opportunity? Stick with me, because the data we've uncovered might just change how you view this entire sector. Let's get one thing straight. The SoFi of 2024 is dead. What we're looking at now is a fundamentally different beast. For 9 consecutive quarters, this company has delivered GAAP profitability. Think about that for a second. 9 quarters. In Q4 of 2025 alone, they posted $1 billion in adjusted net revenue. But here's the number that should make you sit up. Management is projecting 72% net income growth for 2026. While the stock trades around $21, our intrinsic value models suggest a fair price north of $35. So why is nobody talking about this? Here's where it gets interesting. In 2026, we witnessed a classic Wall Street head fake. The stock pulled back 20% despite the company delivering what I call a triple beat. Revenue crushed estimates, earnings per share exceeded consensus, and guidance was raised across the board. The price dropped to $21, while the business fundamentals were actually accelerating. This is textbook institutional rotation during risk-off sentiment, but the underlying business? It's firing on all cylinders with record-breaking net income. The disconnect between price and performance has rarely been this wide. Now let's talk about why SoFi isn't just another neobank trying to compete with Chase or Wells Fargo. They've built something entirely different. By owning their entire technology infrastructure through Galileo and Technisys, combined with a national bank charter, they've created a vertically integrated powerhouse that eliminates the middleman fees crushing their competitors. This isn't just cost savings, it's a fundamental competitive moat. Fee-based revenue now represents over 40% of total income, which means they're insulated from the lending cycles that destroy traditional banks during economic downturns. They're not playing the same game as everyone else. They've changed the rules entirely. But ownership of technology is only half the equation. The real magic happens in their customer acquisition model. SoFi operates what I call a compounding machine. They bring customers in through low-friction entry points, like checking accounts with competitive rates. Once you're inside the SoFi Plus ecosystem, the cross-buying flywheel activates. 40% of members end up purchasing a third product. What does this mean in practical terms? Drastically lower customer acquisition costs and significantly higher lifetime value. Every new member doesn't just add a line of revenue, they expand the entire profit margin of the company. This isn't linear growth, it's exponential. Let's dive into the operational metrics because this is where the rubber meets the road. Net interest margin expansion is the secret weapon here. While traditional banks are hovering around 3%, SoFi has pushed their NIM to 5.72%. How? They're sitting on a $37.5 billion pool of low-cost deposits. This capital advantage is why their 2026 guidance of $825 million in net income, representing that 72% year-over-year growth, isn't wishful thinking. It's a conservative projection based on current trajectory. From a technical standpoint, the setup is incredibly compelling. We're entering what appears to be a major accumulation phase. The Elliott wave analysis suggests we've completed wave 4 at the 1.61 Fibonacci extension, establishing a rock-solid support floor at $19.20. The breakout zone sits at $21.50, and institutional positioning tells us everything we need to know. The put-to-call ratio is sitting at just 0.31. Translation: the smart money is overwhelmingly bullish and betting on upside. So what's this company actually worth? This is where it gets controversial. Wall Street consensus averages around $26, but CEO Anthony Noto has publicly stated that using traditional tangible book value metrics for a high-growth fintech company is, and I quote, idiotic. He's not wrong. When we apply an intrinsic value model using a 1.1 times PEG ratio on 40% sustained growth, we're not looking at $26. We're looking at a $38 price target. That represents a 79% upside from current levels. The question isn't if the market will recognize this value, it's when. And here's where timing becomes critical, because two massive catalysts are potentially hitting in early 2026. First, we're tracking a 58% probability of S&P 500 inclusion by March. If this happens, every single index fund tracking the S&P will be forced to buy shares. We're talking about billions in institutional inflows overnight. Second, new legislation restricting federal borrowing options is pushing high-income earners, what the industry calls Henrys, directly into SoFi's private loan products. These aren't just favorable conditions. These are high-velocity growth engines that could accelerate everything we've discussed. But SoFi isn't sitting back waiting for external tailwinds. Their 2026 product roadmap is aggressive. The rollout of Cyberbank Connecta, an AI-powered support system, is already cutting operational costs by 40%. They're launching an AI financial coach that identifies instant return opportunities for users. And here's the big one: SoFi USD, a blockchain-based settlement layer enabling instant transfers. While legacy banks are still running on technology from the 1980s, SoFi is building the infrastructure of 2030. The innovation gap is widening every quarter. Now let's pump the brakes and talk about what could go wrong, because no investment is without risk. A spike in unemployment would directly impact loan performance and refinance volumes. If the Federal Reserve maintains higher rates throughout 2026 with zero cuts, their refinance business takes a hit. Credit quality is always a concern with any lender, and their personal loan portfolio is sensitive to macroeconomic shocks. And here's the big one: at a 33 times price-to-earnings ratio, there's virtually no margin for error. A single earnings miss could trigger a violent sell-off. The valuation premium demands flawless execution. Before we wrap up, I need to give you a crucial reminder. Like always, nothing in this video constitutes financial advice. I'm not a licensed financial advisor, and this content is purely educational and for entertainment purposes. You should always conduct your own research and consult with a qualified professional before making any investment decisions. Past performance does not guarantee future results, and all investments carry risk, including the potential loss of principal. So here's my final take. We're witnessing what appears to be a structural shift in how banking operates in America. SoFi has built the infrastructure, proven the business model, and demonstrated consistent execution. Recent insider buying, including over $200,000 in purchases by the General Counsel and EVP, signals that those with the most information believe in the trajectory. My action plan? Watch that 1920 support level like a hawk and monitor quarterly NIM expansion. If they hit their 20 to 30% return on equity targets, the current price might be remembered as a once-in-a-generation entry point. That's it for today's deep dive. If this analysis added value, smash that like button, subscribe for more stock breakdowns, and drop a comment below with your thoughts on SoFi. I'm Smart Stock Sam, and I'll see you in the next one.